All right. Good morning, everybody. New month, day one, open range. So we made it through the holidays. If you liked it, well, then, you got more coming. It's going to be kind of hit and miss as we get into the end of the month. Remember, liquidity is a big part of everything that we do, and without it, price does odd things. There's a reason that a lot of people just choose to sit out in the last 2 weeks of the year. So you kind of keep that in mind. There's been a lot of talk about the divergence between equities and digital assets like Bitcoin. One or the other is misdirected. So either the markets go down to get caught up with Bitcoin, or Bitcoin goes up to get caught up with the markets. Now, that doesn't have to resolve itself anytime soon, but we are expecting it to be resolved at some point. Hong Kong basically flat, Japan down not quite a half. The Russell down 1% and the NASDAQ right behind it. The Dow's doing about the best of the group, down around 0.5%. It was a pretty strong run to the upside over the last 5 days, reminiscent of a bear market bounce, or a bullish run in a bear market. So many ways to phrase that, but the main takeaway is that if we're in a bearish market backdrop, then the moves to the upside can be violent and extreme. And I had the fortunate pleasure of talking to a number of really new traders last week who were just completely frustrated with the idea that it was going up. And there's so many analysts saying, be careful, be cautious. It's bad out there and we're in a bear market. Well, how can we be going up if it's in a bear market? Yeah, I get it. The main takeaway is that those analysts know what they're talking about. They've seen it again and again and again. And you're the new person wondering what the heck is going on. Just kind of keep that in mind. So we're going to get PMI, ISM, and late tonight, POW. Not really expecting anything out of POW at that time of night, but if you are trading in the evening, keep that in mind. Auto sales tomorrow. If nothing else, we might have something to play in that direction just for some short-term trades in the intra week this week. Got auctions in the front end. I think the IRX would probably cover all of those. If you want to just wrap them up into that one chart. The Japan 10-year tonight. I don't know how that got past me, but that one's kind of a big deal to keep your eye on tonight. Wouldn't hurt to shop around for some really cheap lottos, up or down. I don't really have a bias on which way this 10-year is going to break, but that JGP 10-year has been crazy extreme, right? Like, if it was an equity, we'd all be salty that we missed the boat, right? It's been a phenomenal run. and extremes, yeah, they can shake out violently. So if you're trading tonight, man, watch the clock. The VIX is back down inside of the 2015 collar. I like how that sounds. We're not talking about 2015 as in the year 2015. David Keller at stockcharts.com has these levels that he likes to use. And I thought they were so simplistic and awesome that I grabbed them for myself. I just always give him attribution. The lower level down here, 15, the upper level, 20. If we're under 20, but we are above 15, then the S&P is just in a pullback. It's no more nefarious than that. That's a big word on Monday, huh? So we're not in, quote, correction territory. It's not a deeper pullback. We're not in a bear market, depending on which analyst you want to listen to or what textbook you want to use for that qualification. We're just in a little bit of a pullback. Now, should that change and the VIX get back above 20, then we would be up here on the top of this, and we would be looking at a correction or a deeper pullback. But we're under it, so we're just looking at a pullback. Pretty simple levels, right? I like that. Simple is good. Yardini, by the way, is still bullish, but he's been bullish on the S&P since the COVID lows, talking about the roaring 20s all over again and how he expected the entire decade to be bullish. He's still tooting that horn. So, you know, that's a really wide perspective, but still, if you know who Yardini is, that old coot has been around longer than most of us have been alive. He's been trading. There was quite a bit of talk about this chart before it normalized. So all of the angst and excitement about the drive up were overblown because we came right back down again. This is the put call skew for the Mag 7. So, you know, we're not at extremes. You can see April there, right? If you're looking at something that you don't normally look at and you're trying to find some landmarks, just go back to the last big event. Well, April was the last big event, and you can see what happened in April. It was all the way up in the upper 20s. So this drive from 0 to 0.15 was getting people's attention, but yeah, that fizzled out. We don't normally hang out on SPY very much, but there was something here worth pointing out. We got this gap close. So my candles are what is sometimes called trend candles. The green ones are hollow unless the close is lower than the open, but higher than the previous day's close, in which case they'll be solid. So these blue solid bars are telling us that, yeah, the close is higher than the previous day's close, which is why it's green, but it's solid because the close is less than the open. And the same thing with the red ones. The red is hollow if the close is higher than the open, but the close is still lower than the previous day's close. So a little more insight than just having all of them hollow or all of them solid. But if you look at the gap close, now I'm a firm believer that the gap is not closed until you get back to where we closed on that bar. Some analysts will say, well, we got inside that bar, that's good enough. The gap is closed because we touched the inside of that bar. To each their own, right? So we got the gap closed on Friday. That's when we did it. If we put this right side chart here, you can see that dark pool print where we tagged it Friday morning. Then we got up there again Friday afternoon. We actually got above it in the later part of Friday. Now we've gapped down, and this is a gap that needs to be closed. So we left a new gap overhead. And we had this trend line that we had rejected against. We got above it. We were holding on to it into the close Wednesday, and we were still above it on Friday, but now we've dropped back down. Now, this pre-market stuff, in the grand scheme of things, doesn't matter too much on this trend line, this angled trend line. But once we get into the market open, if we're underneath it, that's not a good thing. And it's going to signal a bit of like a megaphone pattern, right? There's this sort of a megaphone pattern shape. If we get back down inside of that angled trend line, we've got these gaps to close below. One right there. One right there. We got this half back to deal with. So we've got targets to the downside. We can run it all the way back down. What we have not managed to do is get that higher high, at least not on SPY. So we've been talking about this on that run up last week. The question was, were we going to be able to get above this level or not? And today doesn't count yet because the day isn't closed yet. So this red day that we're seeing, don't count it out just yet. This could be a wick down. It could turn into a day that looks like that for all we know, right? That it could fall down and then it turn around and run right back up again. So we don't know yet. If today closes down and tomorrow we open and leave even more to the downside, that will define this as our next lower high. But we left this low behind and it's a long ways down. And what's very likely is if we do cut this out as a lower high, we're going to be left with this trouble of that's the low we need to break. If we come down and we don't break that low and we begin chopping around in this zone, that's a big zone to chop around in, 350 points ish. And we could put in some sort of topping pattern where we're just hanging out up here. So that's the problem, right? That goes to the heart of the question of, well, what should I do? Are we, overall bullish, overall bearish? We're not bearish unless we break 65.50. But we're not bullish unless we can set a higher high at the bare minimum, right? Otherwise, we're just in this massive range and we're holding the line, and it's not necessarily getting any worse. It's just not getting any better. The call wall and the put wall are pinched. I shared the picture of that image. You should see it in the chat. So there's the put wall, there's the call wall. They're really close together. That's dangerous, especially since we have weeks to go before we have OPEX. Third Friday of the month, we're talking about the 19th for OPEX. It's going to be a while. Typically, having that put wall rolled up like that makes it easy for us to get underneath it and then just drop like a stone because there's nothing there. $75,000 in the volume overnight. Surprisingly, it's above our average volume level. We can see on that overnight Thursday into Friday, that short day, we were running light around 26. Kind of highlights that lack of participation during the holidays. 75, I mean, that's relatively decent. We're getting reciprocation right now. This is the zipper play that I focus on quite often. What you get above VWAP, you look to get below VWAP, right? Measure that out. The idea would be that price just gets stuck in this balanced zone above and below VWAP until finally the balance breaks and we begin the expansion. It's likely, with what we're seeing, the expansion is going to continue to the downside. But I'm reminded of that phrase that the H pattern stands for hell for shorts. Now, that's not my phrase, but that's the going thing. You guys have been around long enough. Hopefully, you've gotten the idea of what I considered the difference between an inverse cup and a double bottom. All we got to do is see how the low is resolved. If we come down and we make an equal bottom, then that's a double bottom to me. Double bottoms are bearish. We would have the expectation. Let's do that again. That would be a cup and handle if it's a matching bottom. Cup and handle would be bearish. We'd look for the upside move and go lower. If it's a double bottom, we need to exceed the low, go lower than the low, because double bottoms are bear traps, and we need to have price actually get into the trap if we're going to trap anybody. So it all comes down to, are we going to bounce here and put a handle on before going lower, or are we going to break down and get into the 111 or the 1236, trap the bears, and then go higher? We are at the ADR half. Now, we got an old phrase that says if we get to the ADR early enough, we can go to the other ADR by the end of the day. Now, I want to make clear, this isn't about bullish or bearish. It's just wave and its effect on price, right? So price, we don't want it moving in a straight line. We want to see these waves. So when we amplify that wave onto a higher time frame, going from one edge of the ADR to the next is just what the average daily range is, right? This is 1.5% or 103 points between these two red lines. And the average day, we move about that much. So if we're already there and we do it early enough, we can go to the other side by the end of the day, just because we still have time left in the day. But going up there would not necessarily be considered bullish or bearish. It would just be a part of that movement of price action. We don't have to go up there, by the way. Now that we've bounced on this low or this ADR, if we break it, then it's game on to the downside, and we'll focus on 67.50. Now these ADRs on the ES, we got them at midnight. If we get under the yellow line and we continue to fall, we don't have any levels down there, right? At least not ADR levels. So what I like to do is, if we get underneath the yellow line and we are continuing to fall, and I'm asking the question, well, now what, right? Now where are we going? Bring up the SPX and look at those same lines, the red and the yellow lines, because the SPX won't get those lines until 9:30. So if the ES is already down, say 1%, and then we open, the SPX gets its ADRs for the day minus that 1%. So they're not even impacting where the levels are going to be. And the ES will often continue to fall or rise until the SPX hits the red or the yellow line. And then that's where we end up stopping. I'm not expecting that today, just sharing the tip that if we get underneath the yellow line and you're trying to figure out where the next stopping point is, bring up the SPX. That little tactic works. We're still above the weekly pivot, but we're inside the weekly pivot channel, and it's a really big channel. This is last week's channel. This is this week's channel. A wide channel implies that even if we do get a breakout, it likely doesn't stick. But we have to have some consideration on what exactly are we talking about breaking out of. Since it's a weekly floor pivot, we're talking about breaking out of last week's range, which happens to be a fairly wide range. So this big floor pivot for the week says that if we break out of this really big range, it likely doesn't stick and we come back inside the range again. Well, okay, but I mean, that's a really big range. I don't know how helpful that is on a week like this, right? If we get underneath 67.82, which is the weekly pivot point, we'll be back into a bearish bias. We're certainly not overbought or overextended in relation to that weekly pivot. Now, the daily pivot opened higher than the previous day's pivot. That's bullish. Price opened above it. That's also bullish. But we came down and hit it. We're now underneath it. So now that we're underneath it, we lost both of those bullish biases. It is a narrow channel, which implies that if we break out of yesterday's range, we likely keep it and continue the breakout. And well, so far we've done that. We are outside of Friday's range and we are continuing to run, not giving it back. We're dancing on the 3-day at the moment. And if we break that, we've got 67.70, which is the 10-day and the 20-day combined. Then underneath that, 67.32 cog line, which is the 50-day. Pretty easy levels, all things considered. All right, we are at S2. Generally speaking, we would focus on an R1 S2. We didn't quite get to the R1 before we made that drive. We're there now. There are times in history where we've gone to an S3, or there's even more levels, right? There's an S4 and there's halves, which I never use. But if we break our own Globex low, we've got S3, 67.70, which lines up with the 10-day, the 20-day, and now the S3. That's multiple levels at that 67.70. A big key number. So I'd say that's going to be the line in the sand, or the fulcrum point for all of this. All right, last week's distribution was kind of a mess, really, all things considered. But we left two distinct distributions and a relatively shallow space behind. We can move through those shallow zones relatively easy, which implies if we break that Globex low and head to the downside, we could drop right down into 67.25 before we even start to see any sort of structure come in and help us out. There is nothing down there. Got a little speed bump at 67.70, that high volume node in a single shot right there. Other than that, it's shallow and smooth sailing. But we are outside the value area of last week. And sure, I mean, we're bouncing on the top side, and it's not a game of perfect. We're kind of wicking inside of it a little bit. If this holds, then we could certainly make a run back up and challenge that high. I know there's a lot of reasons to feel negative on all of this at the moment, but we haven't done anything, right? We don't, it's all sentiment at this point. You know, when that ship got stuck in the canal, there was an actual physical problem that needed to be resolved. When we had COVID, we had a problem. The 2022 bear market, there was inflation, there was a problem. So what do we got right now? It's sentiment, and that can turn on a dime, right? Just one headline away from a rip to the upside that washes all this angst and negativity away. Ten-day, 30-minute volume profile in TPO 6832 has a relatively high level. We're building it out. The candles that made this level are relatively close to us. So, you know, the likelihood that it becomes the new level is going to stick unless we come down and reinforce a previous level. Each new candle on the right removes a candle from the left. We are underneath that 6732, so it's the line that we need to get through to get back up into 6850, challenge that high, and try to get higher. It's a pretty ugly chart, all things considered. And the point of control is made from these candles that are still days away from being taken off the board. So the only way we're going to see this point of control move in the near term is if we can build out a zone. So if we get price down into that 6770 level that we've been talking about, we could build out that level and it can become the new point of control early and force this thing up even before we take those candles. We don't really have a VPOC from Friday since we cut that level. We've been through it multiple times. Like I've talked about before, when it comes to these short days, it's best to put all of this data together into one single shot, right? So you would want to combine everything from that you see from Wednesday's close to today's open as a single Globex event. And then you have today's trading. Unfortunately, if you're not on a broker that lets you draw your own profile from your chosen starting point to your chosen ending point, that can be kind of tricky. But that would be the best thing if you can do that. TradingView can do it, I believe. And on Tradeovate, you got the drawing tool to draw your own profile from a start and finish. We got the VPOC 6768, which is really close to that 6770 level that we keep talking about. Underneath that, we got a high volume node at 6725, another level that we've talked about. Then a shallow drop right through 6650. We are 1% above the 10-week. So this downward trajectory hasn't changed yet. The moves that we got last week set a lower high, and we haven't washed this thing yet, right? So we're not broke out and setting higher levels, but we're not broke down and getting deeper yet. We had that discussion last week when we got below on whether it was going to be a single incident or if it would turn into a multiple level event, and it was a single. But we've got instances where we had a single and just a little up move and then a deeper event. So we can have a single and then a deeper event. This is the concern. The analogy for this, take a ball and throw it in the air, let it come down and bounce. And each bounce gets a little bit lower and a little bit lower and a little bit lower until finally it doesn't bounce at all and it's just laying there on the ground. These bounces that we've been getting have been lower and lower and lower and lower. So we need some new fuel or we're going to get underneath. We're still above the 10-day. We were above 1.5%. We've dialed that back. Now we're less than 1%, but we're still above the half. I've got this little imaginary collar from 0.5% to -0.5%. And then another collar, 1% and -1%. Those are two different zones that I like to focus on. When we get above 1% or below 1%, we got to treat the market a little different. As long as we're within that 1% boundary, things are good. And if we're between the 0.5%, then we're basically back at the starting point and that we have a full run in either direction. Think of it like the center of the basketball court or the center of the football field. It's where everything starts from, right in the middle. Whereas if you're standing really close to one side's goal line, then you have to travel the entire field to get to the other side's goal line. This week's range in relation to last week's range is coming up a bit short. We got some context to that really adds some more questions than answers. Last week was a short week. This range is derived based on two metrics. How much time are we looking at? A 5-day week, a 4-day week, a 3-day week? And then how much volatility are we looking at? So last week's short week compared to this week's full week, we have more days. We should be able to travel farther. The range, just for GP alone, based on how many days we have, should be a wider range this week because we have more days. How far can you drive your car in 5 hours versus how far can you drive your car in 3 hours? All right. Obviously, you can go farther in a 5-hour period. But the range this week is narrower than last week's range, even though we have more days. So if it's not how much time we have, then we have to question the volatility level. Last week's volatility was extreme, which is why the range was so big. The markets were literally pricing in the possibility of a big move. And we got it. I mean, look at the move that we had last week. Not only did we exceed that really wide range, we did the entire move plus some. This week's range is really narrow. At first blush, a narrow week makes us think, hey, the market must not be expecting anything extreme. We're looking at a narrow week. Unfortunately, that's not the way it typically works out. There are volatility suppressing situations that give us a narrow week. CPI, PPI, non-farm payrolls, FOMC, these are all volatility suppressing events. We can see them coming. They're known unknowns. We know that they can be volatile. And so the market ends up pricing in what I term a hurry up and wait scenario. We get all excited about it. Then we sit on our hands for 2 days waiting for the event. And then the event comes and maybe it's violent, maybe not. But that's why the range is so narrow. The market is pricing in a hurry up and wait scenario. So it's a little bit of a trickery. You would think we'd get a wide range for FOMC, CPI, PPI, but we actually don't. We get narrow ranges when we have known unknowns. So they are pricing in the idea that we're going to sit and wait on data this week for at least a day, maybe 2, for one of our events. And I'm thinking it's going to be, well, I was going to say jobs, but those jobs, that's not the one we need, right? We need like non-farm payrolls. We don't have those yet. We do have ADP on Wednesday, jobless claims on Thursday. But it's not there yet. Those are all delayed reports. Not expecting it to be that. ADP employment is the biggest thing to me on this list. I mean, we've still got other stuff like ISM services, ISM manufacturing today, PMI. There are others of note, but the ADP on Wednesday stands out as the biggest. So if we end up going sideways for 2 days waiting on employment data, that would account for the sideways hurry up and wait range here. And we'll know if it's that because on Wednesday we'll get a market maker move. They'll bring in additional hedging on whatever day it is that we're supposed to be waiting for. All right, so looking at what we've got this morning, Bitcoin is down 5%, but it's still up 7.5% over a 5-day period. More Bitcoin. Mag 7 up volume is down almost 3%, but it's still up 15.5% over a 5-day period. So it was up almost 20%, 19%. Of course it's down a little bit. That was a heck of a run. Uranium, chips, the Mag 7, industrials, technology, bonds, growth, banks, quantum, industrials, financials, everything is down. Communications, everything is down. What's up this morning? Nat gas is up. Yay. The China group is barely up, but it's moving in the right direction. And gold miners, precious metals are up. Now they're up 16%, at least junior miners, 16.25% over a 5-day period. That's getting a little bit ahead of itself, right? Watch for a little bit of mean reversion on that one. And then the regular GDX is 13% in a 5-day period. It's getting a bit extreme. So, every day we try to gauge what's the likelihood that we could break out and run today or break out and fall today. And we don't have the sectors for a breakout to the upside and a run today. Not now. We could see those sectors come in later today, right? And that would be easy to see because we would see all the breadth and all the sectors turn and start moving higher. We could get 0-day flows later today, and we could spot that using, like spot gamma or options tools. Otherwise, what would give us some drive to the upside today? Maybe something with the 10-year dollar bonds, but we don't have anything showing yet for a drive up. So what about down? Well, we've got a lot of stuff that's down already, and we're holding this low. So we don't need more things down to get us to go lower. The things that are down aren't enough to drive us lower yet. We need some sort of news or headline or something, and that's what we want to be focused on this morning. If we break this low and begin to expand lower, we've already got our levels, right? So we'll just continue to run it one level at a time. 6770 is the bigger level. My measured targets, the 111, the 1236, 6790. So from 90 to 70. And then all of those levels from last week, right? All those daily levels. The gap close. The moving average is 6732. Level by level, we run it all the way back down. But we don't have any reason to expect it's going to be like that unless we get some news or catalyst or something. Because with all those sectors that are down this morning, we're holding the low that we were set last night. That was set in the Asian session. We got into Europe and didn't even really get a move through the kill zone. We're still holding the low. So I would look for a real change in market dynamic if we're going to go lower from here. And the catalyst could be the dollar, bonds, right? Something like that. I don't see equities doing it like the Mag 7 since they're already down and we're still holding up. I suppose, right? It's as good as it's going to get for a Monday. Keep your eye on the clock. We got to get through the data. The afternoon looked decent. Because this thing with Powell is going to be late at night, so it's not even going to be an issue. Once you're done with the auction, we're done, right? And that just gives us the afternoon for a free run. See if there's anything from the White House. Nope, minimal administrative activities. So nothing really out of the White House either. And the CTAs, that little buying that they did last week, they haven't started to unwind it yet. That's it. That's what we got. Everybody, be careful, be safe. Keep your eye on the clock.